right, we're still waiting for some people to get in here. All right, let's get started. So today is August 21st, 2024, and I'm excited to talk to you guys today about our new panel on positioning and planning for M&A. Let me get the slides up. There we go. Positioning and planning for M&A. This is being live streamed, and I am your host, Jim West. I'm the Associate Director here at BioTools Innovator, and this is our 8th webinar. The general format for these webinars is we do an hour live stream followed by a unstreamed 30-minute Q&A follow-up with our BioTools Innovator cohort. And today I have with me Eric Shu from Wilson Sonsini, an attorney in the space helping with deals and transactions. We also have Jose Haresco, a executive at Thermo Fisher Scientific, and we also have Kelvin Liu, a founder who has exited. So we've got a whole round of expert views here. And what I'd like to do is go ahead and go around and have a round of introductions. So Eric, if you could go first.
Yeah, thanks, Jim. Nice to meet everyone here. My name is Eric. I'm a corporate securities partner at Wilson Sonsini, specializing in corporate finance, corporate governance, M&A, and public offerings, specifically in the life sciences industry. I've known Jim for a year. I've been at BioTools for about 2 years. Very appreciative for this opportunity.
Great. And Jose, could you go next?
Sure. Thanks, Jim. Nice to see you all. Thanks again for having me. My name is Jose Haresco. I am in the strategic partnering group within Thermo Fisher's Biosciences division. Been in here about 3 years, been involved with BioTools for about that long. Happy to always help the ecosystem out. Thanks for having me.
Great. And Kelvin.
Hey, my name's Kelvin Liu. I'm kind of bringing the company point of view here. I started a small genomics company called Circulomics. It was spun out of my PhD and postdoctoral work at Johns Hopkins. We built a lot of sample prep tools for sequencing. The company was kind of unique in that we were all kind of grant funded, so we never brought any equity funding. So we bootstrapped straight from spinning out to our first product launch to an eventual acquisition. And so when I started the company, I always knew that the company I was building, the scale was really too small for like an IPO. So the strategy was always to exit to a large life science company like Thermo Fisher or a sequencing company like PacBio. And so PacBio is a company that eventually acquired us. They acquired us in 2021. And so, the large part of the goal was always to get acquired by one of these companies. And so from day one, our entire strategy was built around, how to build our primary product, right? And so our primary product, was the company itself, right? We sold kits that did DNA extraction, size selection, library preparation for sequencing, and those, generated revenue. But that was just one part of the picture. And so I guess today we'll talk about a lot of the other parts of the picture. But ultimately, the main product was the company itself and how to make that, a useful piece that one of these large life science tools companies, would want to slot into their portfolio.
Awesome. Thanks, Calvin. And I think like like Stephen Covey says, right, begin with the end in mind. It sounds like you really started with that goal, understanding where the value was, what you needed to build, and what you needed to do to make that ultimately attractive to a potential acquirer.
Yeah, so I think with any startup, there's always a little bit of meandering, right? When we got acquired, I think we were on version 40 of our business plan, which looked pretty different than version 1. But along the way, I wanted to make sure that, all the decisions generally got us moving in the right direction. But equally importantly, that we didn't make any decisions that would, shoot ourselves in the foot. Right. So because a lot of these sequencing companies and a lot of the life science tools companies, some of them collaborate with each other, some of them are competitive with each other, right? And so I want to make sure that if I did any decisions along the way, that I wouldn't, block off any opportunities in the future. So, there's always a lot of long-term planning of, okay, this is going to help us in the near term, what's it going to do in the long term, and make sure we set up all those things that, they get us towards our ultimate goal.
Right. Jose, you've got a long view sort of this industry, and you're sort of what you've seen at Thermo Fisher. Can you talk a little bit about sort of your background with M&A, kind of what you've seen and what kind of deals you've been a part of?
Sure. So I'll extend my career has been a little bit odd, right? So I was a banker for a long time in healthcare, and then I was at J&J before this doing M&A. And here at Thermo, we do really M&A or any kind of partnerships that we feel like doing. The vast majority of the M&A work that I've been involved with tends to be fairly large. And I think that's literally by virtue of the companies that we are in. Thermo Fisher in general tends to prioritize revenue, cash flow, all those metrics that shareholders like to look at. I think that's not necessarily true for when I was at J&J, where we always looked at early development stage companies. I think when in the times that we have looked at smaller companies at Thermo, it's really been focused on companies that have substantially de-risked their technology. Right, there's almost always has to be at least some revenue in there, but the product itself and the business model needs to be fairly baked for us to really take a look under the hood. And even then, right, knowing that if you look at our last series of acquisitions in the last few years, they've really been focused on size more than anything else. That doesn't mean we don't look at smaller companies. It just becomes more difficult. But the line pretty much looks like it's got to be a stable business model and a stable platform for us to even think about doing M&A.
Great, Jose, to follow up on that, the deals that you have seen in the past, just kind of curious, what kind of stages of funding or, development of the company have you guys seen? Are they like far beyond Series A? Are they kind of in that Series A, or where
No,
do you
they're
kind of
far
see
beyond.
that?
And when we are working with companies at the A and B stage, we tend to not look at the M&A route. We tend to look at more at various other forms of collaboration, commercial collaborations, OEM, and where we sell it and commercialize. In fact, we're often very interested in partnering with those kinds of companies because we have the commercial arm to sell their product. From an M&A perspective, these tend to be fairly mature companies with substantial revenue attached to it. And I know that can seem fairly daunting for a small company, right? But and it's not just us, right? A lot of times the large caps will have I'm not going to call it guidance, but they want to see revenue north of 10, 20 million, right? To even think about doing the M&A, because it's a lot of work to integrate companies, and a lot of it has to do with the risk, right? When you're at 10, 20 million in revenue, or even north of 5, the machine on the small company side is working pretty well. And our job is to turn that into 100 million or more.
Awesome. And Eric, how about you? You've seen a lot of deals. Can you tell us a little bit about some of the things you've seen in regards to different M&A transactions over the years?
Yeah, I'd say it kind of varies based on the stage of the company, right? The economic environment, the capital within the company. So it can be a distressed deal where it's a fire sale. There, it's kind of get what you can for the deal, and investors want to write off. Other times, it's a pure exit where you sell the company right for multiples of millions of dollars with some milestone or some royalty component, and then kind of everything in the middle where you're selling a piece of the company, right? Whether it's via like some sort of a exclusivity in like a certain region or within a certain field, and that licensing component. Sometimes you sell entered like a distribution arrangement or a collaborative piece of it, right? Or encumbering a piece of it. Sometimes you do like an asset sale where there's a valuable asset, right? And you kind of sell that piece of it off in order to kind of retain money and get cash for the other parts of the company that you retain. So ultimately, it's a matter of kind of what the management's vision for the company is, right? And what the board's vision is. Do they want to have an exit, right? Kind of wipe their hands clean of it? Do they want to see it as like an ongoing concern and they want to kind of maintain the viability of a certain component, right? Is there a pivot? These things all change, right? Kind of depending on the circumstances.
And Eric, excuse me. What can you kind of describe, for those of us who haven't gone through this before, in this type of transaction, there's the sell side and the buy side. What's your sort of relationship in here, and what parts of the M&A process do you kind of do the lifting on?
Yeah, so I mostly represent companies in these types of transactions. So sell side, where we are the startup, right, or we are the company, right, producing product, and we sell the technology, right, or the company over to a bigger buyer like Thermo or J&J or someone like that. And it can be a variety of ways. Sometimes we get a banker involved where the banker has relationships, is kind of used to promote the value of the company, right, has the right contacts with the buyers. Maybe sometimes creates like an auction process where we get multiple competitive offers, people that are really interested in submitting something that's very, very attractive for the company to consider. Other times, there's maybe some sort of a pre-existing relationship between the company and the purchaser. Maybe there's some sort of a strategic investment or some sort of other contact. Maybe it's an entrepreneur that has done kind of multiple companies, right? And they kind of do what we call a build to buy, where they have a strategic exit in mind when they kind of create the company, and maybe it's a spin out from some other company. I'd say in all of these things, it does require a strong management team to lead the company through the exit process, because if you have employees, right, there's going to be questions about what's happening. It takes up a lot of time, a lot of management's time to kind of answer all the diligence stuff, negotiate the transaction documents. And there's a lot of disclosure that ultimately goes out to your stockholders, about compensation of the executives, the major stockholders, what they're getting as part of the deal. And this stuff is always, almost for certain going to be made known to your employees, right, to other investors, other stockholders. And so there's a certain level of openness that you need to get comfortable with as a part of the process.
Awesome. Okay. Well, let's jump into our first awkward question of the day. So, what are some experiences you guys have seen where things have gone bad, where companies, what are some like examples or some things you've seen where a company has made a mistake that negatively impacted the deal? Sort of case studies from your history. Eric, do you want to start this one off?
Yeah, I mean, it could be around a variety of things. Because I'm on the legal side, so I'll maybe discuss some of the legal concerns that kind of arise. One of them is kind of always tax related, right? Did you make sure that you kind of pay the appropriate sales tax and kind of every state in which you're making or just selling your product? There's kind of tax around your founder stock. And so many times that's an individual concern. Like individuals want to make sure that they have maybe QSBS protection on their stock, or they have some sort of a capital gains return on their stock. Oftentimes that will drive deals as well, because sometimes you can have a reorg where it's tax free. You never want to enter into a transaction where the tax benefits or the lack of tax benefits kind of outweigh the value that you get for the deal. Other times it's around IP. Maybe you have weak IP or IP that you didn't get all your employees to sign what we call like confidential information and invention assignment agreements, where people that create the IP in the course of doing work for the company need to assign that IP to the company. So those are always issues, especially if you get to like the 11th hour and you're on the verge of closing a deal and you have a key contributor that hasn't signed something of importance to the company. Then in that case, the buyer isn't, getting all the rights that they would expect to get with respect to the IP. And so they got to make sure that that person signs and that person then has leverage. So those are always risks that kind of come up in the course of diligence or getting the deal done.
Okay. Those are also things that sound like they, except for the tax stuff, it's stuff that sounds like it would also come up in traditional financing diligence as well. So
Yeah, exactly.
that's a
I
swing.
can add company
Kelvin, yeah.
perspective, right? So when we got acquired, that was probably the third time that we'd gone through acquisition discussions. The first two didn't get as far, but from the company's perspective, like you're always on pins and needles until the day that that deal is signed. I remember like in our deal, even though we didn't have many investors, Hopkins, did own a small amount of equity due to our license. And Hopkins being a large institute, it was hard to know like who was in charge and who could sign off on that deal, right? And so I remember it was the week before closing, and we were still trying to figure out who's going to represent Hopkins and sign off on the equity portion, represent Hopkins and sign off that, hey, we're going to be able to transfer this equity, we're going to be able to approve this deal. And like it went to the umpteenth hour. I had to call all my friends, all my best friends at Hopkins to try to wrangle and get that deal signed. And even up to the day before, I was worried that we weren't going to get that document signed. but luckily some buddies came through, we got it all signed and worked out. But it is nerve-wracking, from the company side. You never know what's going to pop up like to sink the deal.
And academics have that natural sort of, we have that view that they're a little bit slower than the startup side of things. So that's good you got that done.
I
Jose, do you
think
have
that
any stories?
there's a lot of things that can kill a deal, to be honest. The ones that stick out the most in my mind are, particularly something Eric alluded to, is don't sell the company without selling the company. In other words, you can, particularly in our space, right, you can enter into commercial collaborations with us, with Agilent, Danaher, or all the big guys, or even medium-sized companies or distributors. Make it clear, right? The reason somebody who's bigger would want to buy a company is to take a product globally across different fields and indications. So as you start partnering with companies, be really clear about what you are letting go of and what you're not letting go of. It's really easy to be, I don't call it sloppy, but not necessarily careful about the rights that you are signing off to, right? And so is it by field, by region, by application? Like really go through that, because one of the things we'll look at is, that can be a red flag for us. So let's say, I'll give a very simple example, right? You've done a deal in a region with the intention of just selling to the research market, right? In Europe, for example, but you didn't explicitly say not, not sorry, for RUO, but you didn't, for example, explicitly say IVD, or you didn't explicitly say certain indications. If it's not explicitly carved out, if I'm the other guy, I might say, no, you can't sell that. Those rights would belong to whoever you partnered with, and that would be a red flag for us, right? Because we obviously want global rights. We've seen a couple of situations where the rights have to stay with another partner in Europe, for example, and that is usually a deal killer for us because we're global. That's not going to be true of every partner, but I've seen that happen. I'd say the second thing is not being really good about your documentation, right, from an R&D perspective. Yes, smaller companies tend to have less robust quality systems, but you'd be surprised at what that, it can be really robust or less robust or not robust at all. And that could be because as we think about scaling businesses and scaling product, we want to know that it was developed well and that the design history files or quality programs are all very much in place. I've seen a couple of those things go sideways where we looked at and go, we had no confidence that the product that we're seeing in front of us was developed well enough to be robust to scale.
Interesting.
And I guess the third thing is manage your boards. More than there have been enough, and it's not just here, but in prior lives where you have one board member who is just holding out. And as much as I hate to say it, it's like it can happen where a deal is dead because of one board member. So manage them effectively, have your boards manage that person. It can happen.
That's good to know. So, Jose, we can start with you on this one. In terms of acquisitions you guys are looking to make, how important is, the value of the revenue, the business model, the pricing strategy, kind of all this work that the companies do to set up their position in the market? Is that the value of what you guys are buying? Are there business, or is it less important because you're looking to sort of integrate the product into an existing component or line? Are you guys growing business? Are you expanding business? moving into new areas. What are you guys looking for in terms of the business model with a company that you're looking to bring
Yeah,
in?
the business model has to be fairly stable, right? I mean, we're buying it. If it's a razor blade model, that's the entire assumption under which any of us are going to model the acquisition price. Um, if if that model is not well baked, right? If you're not building your business with an eye towards, if it's a razor blade, for example, towards very high margins, if you're not thinking about how to scale that, or what the value proposition is, that becomes challenging. There's been numerous cases um, where the business model and the value proposition across the customer segment is not very clear. And we might think it has some sort of value proposition in the academic market, and we go to market and we find it completely wrong. That would be a bad thing, right? So I think it's really important to have all that fleshed out, to make sure which segments you're targeting, make your pricing strategies right, but also your IP, right? I think Eric touched upon this, right? Having your IP locked down is absolutely important, because that is one way we can monetize an acquisition, right? It is a core technology that can be moved to different verticals and different technology classes within something as big as thermo.
I think it's interesting you say that because I've heard many debates about, do we build the company to sell, or do we build the company to build a company and it may sell, or that could be the goal. But it sounds like for you it's very important that they build a business that has the full scope of capabilities with business development, sales, marketing, production, IP, all
Not
of that.
always, not always, but
No,
I
okay.
would say building. I think Eric, sorry, Calvin had a good comment, right? And especially in our space, to achieve IPO level revenues is hard, right? Particularly in the last few years. But building a good business for acquisition is, you kind of have to be able to do both at a certain point in time, right? And hopefully the capital markets get better over the next few years. But you have to build a good business, period.
Yeah.
How you get, because to get to either an IPO event or an acquisition event, you're kind of doing the same thing. You still have to create value, you still have to build your business model, you still have to scale, right? Whether you hire a sales force or not, that's maybe the difference, right? But I don't think you would, and maybe Calvin has some thoughts on this as well, but I don't necessarily think there are, right? Maybe the commercial sales force being the outstanding one, but to get to that point, you would probably do a lot of the same things in terms of how you manage intellectual property, how you build your product, how you drive value and get your value proposition right.
Okay.
I think from the company perspective, all these things that Jose has talked about, like in the last, these points across the last two questions, those were pretty much all the things I was thinking about all the time, right? And so like IP, every time we did a deal, right, we'd had a ton of people that want to exclusively license our technology, either from partners that want to sell products or distributors who want to exclusively represent us. One, we always walked away from every exclusive deal, which, sometimes, that sometimes, people weren't interested. A lot of times people were still interested in non-exclusive, or, I'd set up the deals where, they were short, very short duration, such that an eventual partner could just wait it out in a year and then the thing would unwind. Or, I'd have, exit clauses where, both parties could just exit, right? To make sure that the eventual acquisition partner, could do what they want with the technology, right? Having non-exclusive was also is also a really useful icebreaker to start acquisition discussions, right? Because a lot of times people would say, hey, we'd want to partner with you guys. We've worked with you guys for 2 years, 3 years. We love it. We'd like to exclusive license it, and I'd tell everyone the same thing, which would be, that's wonderful. We love working with you guys, but, we're really not interested in exclusively licensing anything, right? If you want it exclusively, then you got to buy us, right? And then that kicked off a lot of discussions. It's a very easy way to start those conversations, right? And then, we spent a lot of time ironing out all those things from day one that Jose talked about, right? Making sure that we could scale our product. We initially started selling thousands of extractions, tens of thousands. By the time we exited, I think we were at hundreds of thousands. But our whole quality process, our whole manufacturing process, even though we weren't ISO certified, we worked with all of our subs that were, and the whole process was built such that it could easily scale to millions of extractions, and be scalable to, ISO 9001, 1345, whatever our subsequent partner needed. So we always put those building blocks in place so that we wouldn't, our eventual acquiree wouldn't have to re-engineer everything. But
Right.
it was definitely a lot of forethought into all those things that the partners would, because from my point of view, I think every deal could probably tolerate some number of red or orange flags. But once you get too many of those, then the deal's off, right? So we tried to round as many corners as we could, starting with the biggest risks first, and then slowly knocking off all the other ones.
Yeah,
Awesome.
it's
Oh, go ahead.
make sure you preserve optionality, right? Exclusivity deals are a really good way to lock yourself into to a path that you may not want in the future. And then also recognize that bigger is not better, right? And just generally, I'm not talking about Thermo in particular, like Thermo, Agilent, Danaher, we're all very big. That doesn't necessarily mean we're always the best partner because we might not operate in the markets that are best for you guys, right? We might not have the right channel, right? You want to think about who can drive the most value for you, and that's not always the big guys. So think about that as well, right? As you think about your partnering strategies, right? Think more broadly than just, hey, I've got to have. It's obviously validating to have, especially boards like this, right? A Thermo or a Danaher or an Illumina as a partner, but that's not always the best thing. There have been many cases across all of healthcare, not just life sciences tools, med tech, pharma, where partnering was actually a bad thing, right? Where the partner let a program die, didn't invest in it, right? There's lots of blood in the water about that. So just think broadly, be careful about how you pick your partners.
Great advice, guys. I want to move to Eric here real quick. So Eric, you've seen a variety of other deals. Could you talk a little bit about kind of what you've seen? We've got kind of the big perspective, we've got Kelvin's perspective, but what do you see in terms of companies, in terms of like what is the value, what stages of revenue are they at? Is it the IP that's being bought? Is the value in the team? Kind of, can you talk about the perspective you've seen in your deals?
Yeah, I mean, I think it's going back to what Jose said, it's about kind of optionality. And so as you are developing a company, creating it, you're always going to start off on kind of being less mature, just maybe focus on the technology. You got to understand that, acquirers don't want to buy like a science experiment for the most part. They want to have it kind of proven out. That's kind of what the investors are for, right? To get to the technology developed to point of commercialization. And so that is all kind of priced into the deal that the acquirers want to pay, right? They're going to pay less if there's more risk involved. Maybe have some milestones attached to regulatory approvals or things like that, sales. And I think the founders and the management team needs to be aware that they kind of lose control over the company at the point of an acquisition. Nothing is guaranteed other than like the closing price, right? And so kind of no matter what the upside is, right, it could be unlimited, right? At some point, the buyer, may have the opportunity to kind of honestly back out, but not really kind of satisfy all the obligations, right, or all the, whatever the sellers intend. I've been involved in a couple of lawsuits, right, where they're having times where the acquirer shelved the product, right, or maybe they bought it kind of pre-revenue, right, still waiting for approval, and then it doesn't work out, right, then they decide to shut down the program, right, and all of a sudden the founders are kind of at a loss because they expected this big payoff kind of post-closing and it never got to that point. Also, like within a bigger company, a bigger organization, it's a lot, let's say, harder to do the things that you can do as like a small kind of maneuverable startup, right? So there's a lot more risk you can take, a lot different decisions you can make versus within a big organization. There's a lot more hurdles you got to overcome in order to kind of do the things you could maybe do easier if you were a smaller company. So those are all things that are kind of priced into it. And then another point that Jose brought up was kind of option deals, right, or exclusivity. And so I've had a couple of companies where it's build to buy, right, and they kind of have an acquirer, right, that enters into sort of an option agreement where they will buy the company after certain milestones are met and kind of fund it along the way. And I think that seems like a good idea, and sometimes it is. But you always got to remember that the option is always going to be to the benefit of one party versus the other. And so you want to make sure that you're kind of locking yourself into a deal that you feel is appropriate, because it does kind of cap your upside at some point.
Very interesting. Eric, we can continue with you. I think the assumption I think all of us have is that, obviously IP is pretty valuable. We're all told to get it. And it often represents that moat around a company. But, ultimately, how important is IP? Can you do a deal for a company without IP? Is that something that's possible? Or, what is the role of that in deals that you see?
I'd say IP is one of the core things, otherwise, what is the buyer kind of buying, right? Are they buying like contracts, right? Relationships, trade secrets? It's hard to kind of place a value on those things in the absence of something that's protectable. So I'd say IP is pretty important. You got to kind of have rock solid IP. If there is kind of litigation ongoing around an IP, right? Threats of infringement, right? Or threats that you have infringed others' IP. Those are always things that a buyer is always going to look for, the seller to kind of take on that risk, right? Whether it's through an indemnity, right, or an adjustment to the purchase price or something along those lines. So it's pretty important in my mind. I can't think of a large deal where IP wasn't involved. Sometimes you have startups where the founders are the ones that have the IP and like the business plan. And at a certain point in time, once that IP has been kind of proven out, maybe the management team shifts to being more, kind of sales focused, right, or commercial focused, and they bring in kind of executives that have experience in kind of taking the company to the next stage, because the founders, right, don't have the right type of connections or experience to lead it from being kind of a more of a research company to more of a sales company. But those are all, I kind of imagine that, it would be hard to convince a large acquirer to take a shot on goal for a company that doesn't have anything that's able to be protected or kind of able to be kind of exclusive.
Okay. Calvin, I'd like to ask you, when you were building your company, how did you guys balance, what do you patent, what do you trademark? How did you think about that in terms of the value you were creating on the back end and make some of those decisions with your company?
Yeah, that's kind of a fun question because because we were bootstrapped, right? All of our funding came from grant funding. We had very small amounts of flexible funding that we could use to pay for IP. But that's definitely, I think, one of the most important things in my mind that the acquirers of our company would have been buying, right? And so we invested a lot in IP. That was one of our biggest costs every year. We easily invested $50 to $100,000 in our IP filings in every calendar year, starting almost from day one, right? And it was pretty much a constant cost. It just slowly grew, right? And so we had a few core pieces of IP. And then basically we expanded that IP as our product portfolio expanded, right? And so I think, we would think carefully about, what things we could protect as trade secrets, what things required IP to protect, which IP would protect value and was worth that investment. Domestic, like US filings are not that expensive. So I think I don't think we put too much thought into, what we had to file there, but it was usually when we went international that those costs kind of grew, much more, and like Jose was saying, most large tools and platform companies are global now. And so you'll have to file all across the EU, some of the major Asian countries, maybe Australia, right? Maybe Canada, right? And so those costs, they get to be a lot, but we definitely spent, a lot on those IP filings and spent quite a bit of time because we knew that was where, most of the value of the company was coming from.
Okay. Jose, to expand on this conversation, now when you guys are looking at an acquisition, when you look at the product that you're buying, what are the biggest risks you guys look at or that you see when you're looking at these companies? Is it in the product and the scalability? Is it in the IP? Is it the protectability? Where do you guys see those risks and how do you evaluate them?
It's really all of the above. And it depends on the stage of the company, right? If you're buying something that's just getting off the ground, which is rare, then it's about the scalability of the product and the intellectual property. If it's a much larger acquisition, right, we're talking the big $1 billion ones, we assumed that we still look at the IP, but we also assumed that a company that wouldn't have gotten to $1 billion in valuation without having good IP. So it really depends, but all of those are important factors. It's just the weight might differ depending on the stage of the company.
Okay. So I guess with the big deals, a lot of that's probably de-risked significantly by the time you guys are getting involved in those at that stage.
I would say it's de-risked significantly. Sometimes it's not necessarily here, but I've been in cases where, right, it wasn't an IP issue until somebody bigger owned it, because then somebody could pay a check. Not right. No one's going to go after a small company, but if Pfizer buys it, all of a sudden it's worth going after that company, right? That's what it always comes down to.
The small guy defense. That's good. All right.
It's real.
Well, yeah, okay, I would love it if maybe we'll jump back to you, Eric, here for the moment. But can you tell a story of a successful M&A story that maybe had a few hiccups, but you guys got it over the finish line?
Yeah, I mean, I think that in all these deals, there are people involved, employees of the company, ones that are kind of day-to-day employees, right? That obviously like management cares about, but aren't privy to like the deal happening, right, or the details. And so I was in this one deal where it was a pretty good acquisition, right? It was like a Series C company, but it was kind of like lightly funded. And as part of the disclosures, right, that get prepared, management needs to go out to some people within certain areas, right, to get their feedback on like what we call like the representations of warranties, right, just things that come up during the course of diligence that you got to have the right people address and kind of provide responses to. And so obviously the team was aware that stuff was happening because they were being asked to do things that were kind of out of the ordinary. But one of the things that came up was as the deal kind of got to the point of closing, the company had to go out and solicit stockholder approval. And as part of that stockholder approval, the company needs to provide disclosures about any type of management payments that are made in connection with the acquisition. And there was a member of the IT team who was kind of unhappy about what they were getting, right, compared to like what was disclosed about what management received as part of the deal, right? And obviously what management received is not always, I'd say, like what they're actually getting, because you got to include a lot of assumptions about the maximum potential payouts that they could receive, right, which isn't necessarily reality. But the IT person saw this, was really unhappy, basically locked the entire management team out of the IT systems for like a day. They had to get the sheriff to come over, all that stuff. But it's like Kelvin was saying, right? You're on pins and needles every day until you get to the point of closing and until the money's in the bank. And so there are all these things where you understand that like personal relationships, right? People are still involved. So even though a company is being sold, right, stockholders are being kind of cashed out, there are still employees that work for the company that you got to think about, right? Sometimes if it's like the wrong type of acquisition, there's like layoffs, right, all that stuff, right? And so that's all part of the calculus that I think the board makes when determining whether or not this is in the best interest of its stockholders, right? Those things all come up.
That's a crazy story.
Yeah.
Kelvin, when you guys were going through your transaction, oftentimes we hear stories about the management team for one reason or another keeps the M&A conversations private from their employees and the company more broadly until the transaction is closed. Can you talk about why that is and what your guys' strategy was there, and if you had any problems with your IT team during your transaction?
Well, I was the IT team. We were a very small company, so I was the IT team. I didn't need any more headaches to give myself because it was stressful. I was pretty open about the fact that we were having those conversations. We were a small team, very tight knit. We had very low turnover, so many of the people that were on the team, we had been with us pretty much since day one. So I was pretty upfront about the what was happening and the fact that it was going on. But like Eric said, there's a lot of details that are nuances that are that are difficult to share, let's say, because like the deals are they're really complicated, right? And the whole time, like as the guy that was doing most of the work behind the scenes to get the deal, obviously we had accountants, we had lawyers that were doing a lot of the actual, nitty gritty, but managing all that process and doing it, like my main concern was I hope this doesn't blow up. Right? Because one, we had a great partner. It was everything was well aligned. It was a great fit. And then, but also like pragmatically, we had a lot invested into the process, right? The legal fees, the amount of time that we had to spend, that I had to spend, and the rest of the team had to spend to support not just diligence, but later on, I was new to M&A, so this is the first time that I'd done a deal. I didn't know that, like a closing deal pack would be like hundreds and hundreds of pages of documents that literally I'd have to prepare and review. Right. And then so like, you do diligence, you think, oh, we're done. And I did all those diligence docs, 2 rounds, 3 rounds of diligence. And then you come and you have to do reps and warrants, which is basically diligence on steroids. It's all those same documents, but even more in-depth questions that you're spending. And you're thinking, oh, if I answer this question wrong, is this going to blow up the deal? If I answer this question wrong, is it going to blow up the deal? And so the whole time, there are all these little things that I guess that are pretty difficult to share with the team because you also don't want to stress out the team, right? At the same time, we still have a business to run, right? If this deal goes south, we still have to sell kits. We still have to manufacture kits, right? I can't eat up their time and their brain power and distract away from them because of the deal. Because if it goes south, I want the business to go south, right? So overall, we had a pretty smooth process, even though I was very stressed. The process was quite smooth. We had a great partner. But I tried to share as much as I could without sharing things that would cause unnecessary kind of turmoil within the team.
But how early did you share it? I mean, you said this was the third time you went through the transaction process before it went. So did you tell them ahead of time on the other two as well?
Yeah, because so what happened? So like the first time we had discussions was with one kind of tools company. That was like before we started selling products, right? And I'm not totally sure why they backed out. I think it's probably because we were a little bit raw because we hadn't started selling products yet. And then we that discussion actually went pretty far, but didn't go through. And then we had a second discussion that didn't go as far. And then this is the third time that we had acquisition discussions. They were each spaced about like a year apart. Every time, because every time we had these new discussions, the revenue was a lot higher than previous, and we're selling more products, so the company is more mature, and the deal terms were better. So it's actually a good thing. I think the last place we ended up was actually the best fit. But because of all the work that would have been needed to prepare for it, we're a small team. We were only 10 to 12 people. Like it was all hands on deck to prepare these things, right? Because we had to prepare diligence documents, right? So it wasn't something that you could easily kind of shield from the team, right? So I would say, hey, yeah, we're talking to this team. Most of the time, all these companies were companies that we'd already been collaborating for with many years, right? And so, I would just share with them that we're having these discussions. With the last one with PacBio, the CEO came to visit, and so like it's hard to hide those things, right? But I was always of the point that we were a tight knit team. I would share as much as I could, be as transparent as I could, but without exposing them to all those nitty gritty details. It would just stress them out.
All right. So, Jose, we can go back to you. When you guys are connecting with companies in the field and these relationships are being established, I think, it seems like the M&A relationship is a lot like a traditional investor relationship in a way. You go through the get to know you stage, the due diligence stage, and then the transaction stage. How early do you meet these companies in their life cycle? Are they reaching out to you early days saying, hey, here I am, keep an eye on me, let's get to know each other? Or are they kind of already at the more established stage and they're reaching out and saying, hey, we want to talk about dating?
Ideally, it's both. Me personally, I mean, we have a preference for getting to know companies early. I would say it's better to come to us when your product is, when you actually have something to show us, right? A product that works, right? Even if it's an alpha, that way we can track it. There are situations where people come to us and this is not just here, like when even in my prior life, we just had no idea what's going on. Like we didn't know they were out there. But that's more and more rare these days. I would definitely encourage any company in our space to get to know your BD folks in the ecosystem early. right? But generally speaking, it's good to be at the point when you have something concrete to show us. It's very hard to get a large cap's attention when it's an idea on a piece of paper. That doesn't mean these things don't happen. It's just really hard to get people's attention because we will always prioritize, not always, we will tend to prioritize things that are solid or a little bit more baked that we can see and some sort of end game, right? Whether it's a partnership of some sort or whether it's just something to watch, right? There's lots of companies that are on our radar screen that are in early commercialization that we are watching. And that's you want to do that would be the right thing to do. And then it's true of pharma and medtech as well, right? So
We
Eric,
definitely.
oh yeah, go ahead, Kelvin.
Sorry. I was gonna say, we definitely went down that route that Jose is saying, and we engaged super duper early, right? I think from day one, we looked at the probably 10 or 20 people that could potentially acquire us and be a good fit down the road, and we built collaborations with them from day one. Just pure collaborations, right? We collaborated with Thermo quite a bit. We worked with a sample prep group in Austin quite a bit. We were probably way too small to be acquired by Thermo, but we co-collaborated on automation. We brought those collaborations with us to PacBio. PacBio is now a strategic partner with Thermo, on the sample prep and instrumentation. And interestingly, one of our first collaborations was with PacBio. We put out our first scientific paper with PacBio. Our first circulomics branded scientific paper was with PacBio. And at the time, they had a different management team, but we collaborated with them commercially then for the next, 5, 6, 7, 8 years, 10 years. And then eventually, they ended up being the one buying us. So I think it does take some time to build those relationships.
It's great. Jose, while I had you, we had a question come in from LinkedIn while I got you. I wanted to ask, and the question is there any version of reality where you could see yourself going technical again and stepping away from the private equity style role you're in and back into your PhD computational skills?
I think the only time I would consider that is actually, I mean, I love the computational side, but I also love the deal making side, right? So, yeah, at the end of the day, that is my skill set over the last 15 years. So, is there a role where are there times when I can see that happening? But it would probably be on the deal side for a company that is steeped in computation, right?
Very
On
good.
the other side, that's
Blend it
probably where
together.
the overlap is. I don't think I'd ever go back to being a bench scientist or coding again. And that's a question. I think that's not going to happen. But if somebody were to say, "Hey, go do a bunch of deals for computational companies," that's always a possibility. I think that's true of any of us who are in BD. Like at the end of the day, we're deal people.
So any of you can take this next question. It's really about, again, the value of a company. Are a lot of these acquisition deals, are they done based on revenue? Like, do they look at the revenue and is the value ultimately a multiplier of revenue? Is net income parceled into that? How do you guys look at the valuation and spending? And if you're a company and you're like buying yourself a reimbursable cup of coffee every day, and there's a 5x or 10x multiplier on the nets, that coffee's costing you 20, $30 a day. So what do you guys think about that?
I'll speak from the perspective of a buyer, but also as a former banker. It's just revenue.
Just
Most of the
revenue.
time, it's a revenue, and it doesn't mean we don't look at earnings. It doesn't mean we look at profitability. But when we look at buying and selling companies, particularly the profitable ones, it's largely about how much revenue is being made, and what kind of synergies we can extract out of the business model. Right. But usually revenue, and there's lots of ways you can comp it financially to the public markets, to the private markets, to deals that have been done. Right. Is it in an ideal world, you are comparable to multiples on the revenue side and probably in the EBITDA side. But for growth companies, EBITDA can be hard because you're almost always losing money. And for more stable companies where you're talking about, $100 million in revenue, yeah, it's easier to pull out EBITDA numbers. But for growth companies, they're almost always burning cash, right? So revenue tends to be the metric. I don't know if Eric and Calvin comment on that. But
Yeah, I think it's really hard for companies that are pre-revenue, right, pre-commercial to get acquired, just because, some sense, right, that the de-risking hasn't occurred yet. I think that so you can have like a good idea, right? But no one wants to buy, what I referred to earlier as like a science experiment. That they want to kind of know that there is some value that has been proven out, and the best way to do that is to get revenue, right? And I think that you kind of, we leave it up to the bankers, right, to make that determination about the value kind of outside of just revenue. But I think that kind of goes to the core point of like deal value, right? Is like, what is the buyer getting, right? And how do they value that?
So we had another guest that I was considering for this panel that wasn't able to make it. They were an investment banker, and I asked them kind of, what is the most critical factor from an investment banking perspective that you see kind of in the field? And his response was, when it comes to revenue, it's not necessarily the total amount, it's also the type of revenue. So he said it's better to have a distribution of revenue de-risked across multiple income sources as opposed to all of your revenue baked into, a few key clients. Do you guys have any experience with that? Calvin, from your perspective, were you thinking about the way you were getting your revenue and how to diversify that? Or, Jose, do you guys consider that as much well on the acquisition side?
I wouldn't
Calvin, you can
say
go
it's
first.
oh, sorry.
Sorry.
Go ahead.
Yeah, I mean, from the company side, we definitely did both. We had a lot of small retail customers, onesie twosie research labs, so buy a kit here and there, and we also had OEM customers, right, that were kind of large on a OEM deal that would order large amounts on a fixed quarterly basis with projections and all that, right? So I think having that mix was really nice, right? Because tons and tons of onesie twosie customers for a small company is very difficult to manage, right? It's in many ways, even though the one large customer wants a little more attention, it's also in many ways a lot easier, right? So I think having that mix is healthy, right? Because it gives you that flexibility such that you aren't beholden to one customer, but then you also have relatively stable revenue sources that you can bank on, right? So I think agree that having that mix is really important. So we built our products and then the business model to actively go build both of those, right? And so we had our onesie twosie customers, but then we also worked a lot with large sequencing and also life science companies to try to build those stable kind of large customer OEM revenue sources as well.
I'll answer the question perhaps slightly differently, which is it's not necessarily the breadth of the revenue, but to me, it always comes down to validation, right? If you have lots of different types of customers, your lots of people have been kicking at the tires, right? And the breadth of the customer base will lead you to different types of problems and solutions. And so if you have customers in academia and large pharma and public health, right, and those are all of our customer bases, right, we know that you will have probably solved issues very specific to that customer type. So it validates that the breadth of the customer. And so it's easy for us to envision, and I'll say this not just for Thermo, it's easy for an acquirer to say, oh, they've proven this out across different market segments, and therefore I just need to scale it. It's a different problem where when a company comes and says, hey, I've got $10 million in sales, and it's only in one segment and only in one region. And by the way, it's like, it's only the University of California. I'm making this up here, right? Then the problem statement for the acquirer is, okay, how do I branch out of the University of California? How do I go to Pfizer and Biogen and those other companies? Like the business model and the relationship with those types of customers hasn't been fully fleshed out. And particularly when you get into life sciences tools, the workflow can be incredibly different across all those different customer types. And so they're going to bring you different kinds of problems. So in that breadth, you've solved, right? You solved the uncertainties around the workflow. You've solved probably customer service issues. You've improved your product lines. You know how to keep them all happy. And so, yes, revenue ties into that, but that's the other aspect of it, right? It's like to get to that revenue, you will have solved a lot of tactical issues for us.
Awesome. All right. Well, I think we got time for one more question. This one came in from LinkedIn. Are there any general warnings or concerns about diluting equity across too many investors? And I'm gonna kind of I would spin this a little bit, right? Like we talked a little bit earlier about how, potentially a board, a bad board member can make a deal fall apart. Can too many shareholders be seen as a bad sign? There's probably issues of dilution in there. Eric, maybe you could kick this one off. You've seen a lot of these different arrangements. Is too many investors on the equity cap table a concern at an M&A transaction?
I mean, I think it's more of a logistical concern most of the time, right? We talk about herding cats and dogs, and so what's going to happen at the point of an acquisition is, it kind of depends on what the voting requirements are under, the company's charter and bylaws, right? Is it a simple majority or is it something more? But above and beyond that, oftentimes acquirers want to have, certainty about the fact that you're not going to have any stockholders that are going to complain about the deal at the point of it closing, right? They can exercise what we call like appraisal or dissenter rights, where they basically contest the deal and say you didn't get the fair value for the deal that you should have gotten. And so one of the ways that that's able to be addressed is you get those people to sign a document that says that they approved the deal ahead of the deal closing. And so many times the acquirer is going to want to make sure that they have as many people signed up to that kind of approval document as possible in order to reduce the exposure they'd have for like a claim for appraisal rights. So they'll ask for, 95, 99% of your cap table to sign onto the approval document. And that's a lot easier to get if you have, 5 or 6 people that you go out to get to that threshold versus having, 200, 300 people, right? That's a much broader solicitation that you got to do. A lot more, I'd say, risk and time goes into that because people talk, right? And time kills deals. And the longer that you have to spend trying to get that approval, right, the more calls you got to make to socialize and explain it, the more concern you have that the deal may not get done. Either because people want to have questions about the deal or don't agree with it or whatever, right? So I'd say it's not a bad thing in and of itself because you also got to get to the point of having a deal on the table, and sometimes that requires getting money from different investors, right? You get to that point by having dilution, but you got to understand it's a logistical concern at that point in time.
Do you see company CEOs sort of getting like trying to bring in two parties to play to sort of do their due diligence and de-risk that part of it, saying, you didn't get the best deal or, anything like that? Is that a common practice?
Yeah, I'd say usually for like venture-backed companies, right? There's usually investors that are either represented on the board or have observer seats. Kind of they hold large chunks of the stock, right? And so they may not themselves be able to get you to that super high threshold, but they can kind of give you some feeling for whether or not the deal is a good deal. There are always other people that you go out to as well, right? That may not be on the board, but are key advisors, right? Or maybe have a banker involved that will be able to provide guidance, right? Kind of help you, kind of address things in the right way and kind of point you towards whether the deal value is worth it. So you can always kind of market check that stuff internally, right, as a part of evaluating the deal. And then you always want to socialize this ahead of time with your stockholder base just to make sure that they are aware that the materials are coming, right, just so you can kind of get ahead of it. Obviously, it's a lot more difficult, and you probably wouldn't do it for hundreds of stockholders. But sometimes you have a few key stockholders you go out to, and you talk to them, right, get a feel for whether or not they would object to anything, right, and then you kind of try to figure that out first before you actually go forward with a formal solicitation, because you want to make sure that you don't have any roadblocks that come up that you weren't expecting.
All right. Kelvin, Jose, any last words? All right.
You covered it all.
Awesome. Well, thanks.